So you want to buy up a whole company, huh? Well, you probably need $5 billion and to at least know how to figure out that pricing. Market cap, which is the slang term that financial nerds use for market capitalization, is the total number of shares outstanding for a company times the current market price. In essence, what it means is that you're figuring out at a point in time what the total value of a company is, and in theory, how much it would cost to buy it all out. Now, it's not really the real cost because what would happen if you were actually going to buy this imaginary company for $5 billion, you would probably signal to the market that you were going to do it. When that happens, the market price of that stock would start to go up. That is why when a company acquires another company, the company that's being acquired, their share price will go up after an announcement like that because it's usually acquired for above the current market cap. Now, the investors of the world will categorize stocks into three categories: large caps, mid caps, and small caps. Large caps are your stable companies. Think big companies that you might use every day, the Walmarts of the world, and so forth. These companies have some room for growth. They also might have a dividend, so they'll give you money every quarter for owning the company. But their growth potential usually isn't that high. Let's just not talk about tech stocks right now, but typically the growth potential isn't significant. You're looking at maybe a 15 to 20% growth opportunity for a good large cap stock. The risk, however, is what's really appealing. Usually for large cap stocks, the risk of loss or volatility is typically lower than mid and small cap stocks. Now, speaking of mid cap stocks, these stocks are typically the ones around a $2 to $10 billion range. Anything higher than 10 billion is about a large cap stock. Now, mid caps are interesting. They have a higher opportunity for growth, and they have a high opportunity for acquisition. These companies typically have proven revenue, and they have a proven market cap, as in it's proven that they're valued correctly. These companies have possibly revenue. You might have used them before. They have to figure out if they want to keep growing to become a large cap stock, or if it's time to get acquired by a bigger boy and get their shares sold. And I said before, when the company gets acquired, that typically means that their share value goes up. Finally, there's small cap stocks. Small cap stocks into the dark realms of the markets. Small caps really have the highest opportunity for growth potential. You have to understand, large cap stocks used to be small cap stocks, unless they IPO'd at a much higher valuation. So these small cap stocks have an opportunity for much, much higher growth. But with higher growth comes more volatility. The biggest risk that a small cap stock can have is that after you purchase them, the company gets delisted from the market that it's on. That might happen when their market cap goes too low, their liquidity goes too low. They've stopped meeting some kind of requirement to be listed on the stock exchange. That means that if you owned that company, you're going to have to sell your shares through processes that private companies have to go through, which isn't as easy as just going through the stock market. That's why stock markets are so nice. You can get in and out. Now, these small caps, also known as penny stocks, have a much higher reward base. You really can make significantly more returns, but do your research, because with those high returns, there also is a risk of losing all of it. My name is Chester Johnson. I'm the co-founder of Stockteamup.com, and this is Finlit. We do financial literacy videos every week. Thank you.